I use a very simple tool before even we go to the real chart data. There's something called the fib tool. The fib tool, it's not an indicator. Let's start there. The fib tool, it's just a tool that was created because price respects those zones. It's not an indicator. It is just a tool that helps me to place my trades, to put an SL, and to put a take profit. Okay, so a fib tool consists a lot of let's just draw. This is my fib tool. It consists a lot of coordinates. It consists a lot of points. You can see here there's 0, there is 0 0.2, there's 0 0.5, 0 0.6. So a lot of people use fib tool differently with different points. Mine specifically, as you can see how I have highlighted above, I have highlighted the 0, the 75% or 0.5 points, 0.1 0.71, pardon me, 0.71% or 71%, 0.1 points or 71% point, and 1. 1 here, if you make these to be in percentages, it will be in, this one will be 100. We can actually, let's make this. It's actually, when I draw it, you'll see it's on percentages, but here there's 0 0.071, 0.75, and 1. This one is supposed to be 1. Okay, so many people use fib differently. There's someone who will tell you I entered 0.5 and the SL is 0.71. That's okay for them, but for this specific strategy, we are going to use these 3 to 4 points. Sana sana it's 3, or you can even use 4. So the 0%, 71%, 100%. Okay, guys, so if you want to get to a trade, if you want to get to a trade with very simple strategy that you even don't need 15 minutes to go over and over analyzing the market, you just take the fib tool, you go to the market, and you place, if it's a buy or the bull market, you start drawing from the lower high. Get that right? From the lower high to the higher high, okay? Because we are not so sure. We are speculating that this market is going to be up, but we are not so sure if it's going to break this point. So what you do is you draw from the lower high to the higher high, and then you mark your 0.71%. You enter at the 71%. I want to just reduce it, I want to reduce that, the extent. I want to reduce the extension. Yes, this one. Correct. I see now, you can see it. So you just draw from the lower high to the higher high and enter at the 71%. Sijui kama umeelewa. Let me come again. If you are going on a bull trend, you enter the trade. This is a bull. This is a bullish market. You enter the trade from the lower high to the higher high, and your entry will be somewhere 71% or 75%. So the reason why I use 71 and 75%, it's because of the risk to reward ratio. The risk to reward ratio. Let me show you. If you get in the trade, and when you get into the trade, you enter at the 71% of that region. Remember, this is not, you just don't enter at the 71%. You enter at 71% plus other conferences that I've been sharing with you. You will get a 2.5 RR. You'll get a 2.5 RR. I am so sure here I've not drawn it correctly. Let me just, I'm not forcing, I'm just drawing it to the exact lines. You will get a 2.5 risk to reward ratio. This one is okay. Yes, a 2.5 risk to reward ratio. Sorry about that. Let me just go back. Where were we? Where were we? Okay, here is my drawings. Okay. So if you draw it very correctly and you put your coordinates at, let's say, you have the magnet on, you put your coordinates there, you will get an exactly 2.5 risk to reward ratio. We're just trying to get it right. Okay, 2.5 to 2.6, 2.5, that's thereabout. You can see here there's some space, but it's 2.5 risk to reward ratio. If again you enter and you say, I'll not enter the trade at 71%, I'll wait it to 75%, you will get a 3 risk to reward ratio. That is 1:3 risk to reward ratio. Okay, guys, so that is how I trade. And this is just the part 1 of how I trade. So let's go to the other conference that I use. One, I told you about break of structure. The other thing that I use and my trainer must have, remember me telling you about fair value gaps. So what is a fair value gap? A fair value gap is a space that let me use real-time chart data here for that, because that I can just don't miss it, or some of you would not miss it, and some nice one. This is it. Here we have it. So a fair value, actually we are going to use this candle. A fair value gap is a place that money was left behind, or there is a gap that was not filled, in the market during candle formation. Okay, during the candle formation. For example, you take this candle, you take let me just take a drawing tool. Let me take this highlighter. You take this candle and the other candle. You see, this cell candle, the green candle, has some spaces here. I don't know if you're seeing it. It has some spaces here. If you are not a very beginner in forex trading, you know about fair value gaps. So these fair value gaps is one of the conferences that I take with my strategy. So remember, we said that we trade at the 71%. That is where we get our entries. Okay, guys, at the 71% is where we are going to get our entries. So this 71% zone, if my fib will not be touching a fair value gap, yeah, understand that. If the fib will not be touching a fair value gap here, I will not take that trade. I will not take that trade. If the fair value gap is down here, that means the price might not respect the 71% fib. It will come down here, probably not even hit a sell, but it will come down here. This was the trade. Come here, fill the fair value gap, and then start buying. For me, this is very risky, because you see now my SL is very, 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 very close. And I'm not willing to risk that trade, because what we always say is there's a trade today, there's going to be a trade tomorrow. The only time that we don't trade is on weekends. So there are opportunities that are going to present themselves to the market. So if there is no fair value gap in the 71%, I am not going to take that trade. The 71% or the 75% at most. But so many of the times, me, I don't trade the 75%, I trade 71%, because you find that when you wait for the price to come at 75%, most trades you will miss them. And so that, because I don't want to miss them, I get in the 71% and get a risk to reward ratio of 2.45 RR. However, if you get into 75%, you will get a trade worth 3 RR, or 3 risk to reward ratio. So the other one is liquidity sweep. And if you want to learn about liquidity sweep, I'm going to make a video for that next time. But for right now, what you need to do is you join the Telegram group or the Telegram community, link on my bio, and then you can get to learn more about this very, very, very simple strategy. What have we said? First of all, the very first thing you need to do is identify the trend. Identify the trend of the market. First of all, know, is it a bear market or is it a bullish market? If you understand if it's a bear or a bullish market, then you get to understand where to draw your fib level. If it's a bull market, we said you draw from the lower high to the higher high, from the lower high to the higher high. If it's a bear market, if it's a sell market, this is the sell market. Let's draw the sell market here. If this is a sell market, sorry, I'm not very good with the drawing, eh? So this is it. We are just doing. I know you know about sales market. I know you know about the bearish market. This is a bear market. If you are taking your trades, if the market is on a bear, or if the market is bearish, yes, if the market is bearish, you draw your fib level from the lower high, from the lower high to the lower low, from the lower high, let's draw here, from the lower high to the lower low, from the lower high and to the lower low. Who can tell me why are we drawing exactly to these coordinates? Absolutely, we are drawing exactly to these coordinates because if the market reverses here, for example, if the market let me use this one. If the market came here, touched this low, and then broke this protected or this previous lower high, then this one will be a change of character or a market structure shift. It will have changed character from a lower trend or from the bear market to a bull market. So that is why we draw at exact points where we know that the market, if it reverses and comes back here and breaks this high, you just know that the market has has changed character and is now a bull market. So you draw your fib from the lower high to the lower low. If it's on a downtrend, if it's an uptrend, you draw from the higher low to the higher high, higher low, higher high, lower high, lower low. Okay, then you take your short positions there. Again, let me show you. It will be 2.45 RR if you get into the 71%, and if you get to the 75%, you get a risk to reward ratio of exactly 3 RR. Okay, so but remember, we have to have a fair value gap here at the 71% if you're taking your trade at 71, and at the 75% if you take your trades at 75% fib level. I want to draw it exactly so that we can have the exact points, and you'll see it's 2. Okay, it's saying 2.42. Oh yeah, because this one is not exactly at the desired place, but basically you see it's 2.45 RR, exactly there. So you'll get a 2.45 RR, and that is how you take your trades. Very, very, very simple strategy. If it's an uptrend, what do? Let's recap. You take your fib level and you mark your zones at 71% or 75%. You draw it from the higher low to the higher high, and then you enter 71 or 75% you are liking. But you must backtest so that you can see and you can know your strategy. And if it's on a bear market, you take your trades and you take your fib retracement tool. This is not an indicator. You draw it from the lower high to the lower low. Okay, guys, so that's it for me. My name is Ken K Money. Remember to join our Telegram community where I'll be dropping my setups. Every setup that I took, I'll be dropping them there on my Telegram community. Let's learn, let's get to engage with each other.